Good morning. This is the chart of the week. And today I want to address the general economy and the outlooks for the economy, because I think we start to have a sentiment now in the market where people think that everything is fine, that the Fed is coming in to do cuts and hence supporting the economy. It seems like the whole understanding with the labor market actually not being well is kind of being disregarded. It also looked like that in the FOMC presser yesterday. All talks of difference and various reasons for why we see that development. And I just want to focus in here on some very specific concrete data points. And one of them is the U.S. Recession probability here by Macro. And if you look at that, we can see that the data here goes all the way back to the 1950s. And every time we see a rise in the probability there above a certain level, we have seen a recession setting in. And every time we've seen a rise above 30%, we had the recession. Here, and so on and so forth. All the yellow markings here marks the recession that was about to or already had started when this probability rose above 30. Right now, we're just below 40. And people can, of course, claim that this time is different. I just don't see the reason why. So I think that the reason where people start to talk about, now, this time is different because this and that, needs to look into these kind of things here. Just keeping it very, very basic. And I think if we just take another step into some of this and look at, here we have the job openings, which is the blue line, and then the reddish kind of line here, or dark red or whatever it is, I'm colorblind, so please bear with me, is the S&P 500. And you see how that when the real economy is following with the S&P, we can kind of say, okay, things are, developing in alignment with what is happening in the real economy in the financial market. But right now we have a complete disconnect between what the financial market seems that is going on and what the real economy seems to think that's going on. And we're also seeing that the unemployment levels here are moving higher. We're seeing this rounding bottom here, which we have seen into the different recessions we have seen in this time frame here, in 2001, 2007, and also into Corona. We saw also, of course, a much more spiky development. So that to conclude based on this, that everything is fine, well, at least I find that a little difficult. I can see that there is a disconnect between what the market thinks and the financial world thinks. But to the real economy, that is really where things are happening. We can also look at this in another manner, and now we had the FOMC yesterday. And we have to understand that when the short-term yields drop, this is the one-year government bond yields, we see when they start to drop, the Fed tries to follow. And the short-term yields often drops into a recession. The green area here is a recession. So when they start to drop fast, and especially when we have the business cycle model recession indicator, which has only triggered every time we have a recession. So here it triggered here, and also before Corona, and it has triggered again. So if we look at this and we see this decline in the short-term yields that started here and also here, and even into Corona as well, there was actually a slowdown before it became a pandemic. We start to see that the one-year yield actually start to decline here and crossing this neckline. We see the momentum of it is turning downward, like what we saw here. And at the same time, as I already shown you, we see unemployment moving higher. So for people to look at all these pieces of evidence here, we never know. That's not a crystal ball. I don't have a crystal ball that works in terms of predicting the future. But if I have to be a good detective, economic detective, and I look at these things, well, I have to say I think there's a bubble in the financial world, and everybody who kind of follow that thinks that the real economy is going to follow the financial world and everything will be fine because of what the S&P and AI stocks and so on are performing. Or you are in my world, which is the world where we look at the consumer and understand that the consumer is not well in the US, and that is driving the real economy, the business cycles. So this, time will show, time will be our judge, but I think we need to be careful because, as I said, When the recession indicator that I showed you here has flashed and moved above 30%, it has always turned into a recession, and that is also what a lot of other data is telling us. So let's see about it, and that's all for this time, and I'll be back next week.